Hello, my name is Eddie Topic. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of Chicago wheat, Chicago corn, and Kansas City wheat. Chicago wheat. The rise of the market back in late April, up through all the moving averages, as well as up through some considerable congestion between September to November last year, and again in mid-January to mid-February this year. This was the start of the recent move higher and the creation of the early February to late April reverse head and shoulders bottom that gave us the move higher in the first place. If you wanted to pick a date, then the 23rd of April, with a clear close over the dark blue neckline, currently at 582. That was the day. I said about this 4 weeks ago, and I quote, "There is enough integrity in this pattern to allow some potential targets for its topside. Thus, a primary target X would be in the 635 area, which isn't that far away from recent highs. We also have a secondary harder to reach target X1 in the 655 area. Both of these would seem to be doable as they are both under the bright red neckline extension, though target X1 is above the previous double stroke triple top, which makes it that much harder to reach." End of quote. The bright red neckline I refer to is the neckline extension of the small October to November 2020 head and shoulders top, currently at 666. And the double stroke triple top is referring to the one you can see formed in December 2023 with highs just under 650. In reality, the market blew through these resistances pretty easily, punching through the red neckline 2 weeks ago and obviously reaching both target X and target X1 easily in the second week of May. So what happened next? Well, prices also easily pushed up through the 50% Fibonacci line, the July 2023 to March 2024 move at 660, which was a little bit surprising as I thought we might see some resistance there, as well as clearing the 50% absolute Fibonacci line at 682, which was even more surprising, though prices did choose to take a rest after pushing through and utilizing the 50% absolute Fibonacci line as a support before the most recent attempts higher at the October 2013 high at 721 and March 2014 high at 725, where we have seen a small tempering in the aggressive move higher, and especially at the January 2022 low at 739, where we saw this week's peak. In the process of moving higher, the market created a late April into May very steep and very acute purple highlighted bull channel. It has become somewhat of a bullish expanding wedge pattern, currently 721 to up off the top of my daily chart. I said about this pattern last week, and I quote, "This bullish pattern will run this market until something comes along, something suitable to challenge it." And I think I might have spotted something that just may do that. I had to go back to my longer term charts to find it, but just up ahead, highlighted in green, is the neckline extension to the big yet very thin head and shoulders top from the big moves of 21 and 2023, and that's currently at 756. I suspect as we approach this neckline we may see some trepidation and possible anxious and apprehensive behaviour. I know I would be if I was approaching it. The only comfort I can give is that we've had 2 golden crosses this week and we may have another soon. End of quote. Well, the market's approach at the start of this week to this very same green highlighted neckline caused enough of a situation to occur that prices have exited by effectively just going sideways, the purple highlighted expanding wedge pattern, though through the very steep uptrend actually. Now, this doesn't mean this is the end of the move higher, but it does mean we will have a pause after what has been a very sharp rise since late April. The key level to watch on the top side is the green neckline, and the key levels below for now are the 80% fibs, sorry, the 50% fibs, and the two of them, and the bright red neckline. Chicago corn. The medium moving average, currently at 450, had been an effective cap on this market throughout 2023, most recently October, November, then December 2023. It was also once again capping rises in late March and April, but in early May it was breached and effectively broken. Prices went on higher through May to tackle the bright red highlighted extension to the lower trend line, currently at 467, of the July 2023 to January descending triangle, January 2024 obviously. And we may have been tackling that same extension now for 3 weeks. Prices also tackled the gold highlighted slowly descending and now flatlining long moving average, currently at 470, and again are still tackling it for a 3rd week. In the course of this move higher, 2 things have become obvious. Firstly, we have a late February to date bullish halfway hesitation, potential up to the 488 area, though it looks a bit far away given some of the recent action. However, this 488 level will become significant shortly. Secondly, it has provided me last week with the opportunity to draw a late February, mid-April bullish Andrews pitchfork. I thought it looked good, a good one last week, but this week, not so much, which is why I've changed it into a shallower bullish shift pitchfork for the same move, which you can see is highlighted in dark blue on my daily chart. The market has made a show of expanding upwards towards the upper time, currently at 493, as well as earlier moving down towards the lower time, currently at 459. Prices are currently testing this lower time, and I will speak about this shortly, but first I would like to speak again about the 488 area overhead. You see, not only is this the potential target X for a proposed bullish halfway hesitation, but as I said 4 weeks ago, and I quote, if any try higher is to overcome the combined red trendline extension and gold long moving average. After this, there is a free area overhead until we come to the same old congestion band between 490 to 498. So much of it in the middle of last year, end of quote. I said that 488 area would become significant as it's not only the ending of one pattern, but the potential beginning of another. And I'll now look at this week's action and its significance. See, this week we are set up already for a possible weekly key reversal. Thus, if we close tonight either over 475 or under 462, then we'd be on. Anything in between and would have a lesser outside week. Right now, we are set just about to become a weekly key reversal down. In addition to this, we are on the verge of exiting down through the lower time, the dark blue bullish shift pitchfork. We haven't done it yet, but we are close to taking that momentous step. However, it would not be an easy journey if it takes place at all, as just below the lower time, we have the green highlighted and rising short medium moving average, currently at 455, which is effectively reinforcing that lower time. A little below this is the medium moving average, currently 449. And that is a significant level as it is a doorway to the main congestion between 440 to 450 that is the essence of the big February to date halfway hesitation in the first place. So you can see there's a lot below the lower time. And I'm not sure the market can take it all on. Not yet. Kansas City wheat. Late last year we saw the development of a descending triangle from late November 2023 to mid-February 2024, highlighted in purple on my daily chart. 13 weeks ago we had an attempted breakout below, but prices hesitated, then continued to hesitate, such that what I initially thought might be a triple or quad bottom eventually became a quintuple bottom, and also a rectangle pattern. On the 22nd of April, yes, I can narrow it down to a single day, we saw the first significant breakout of this rectangle pattern on the upside, piercing, and then the next day closing over the medium moving average, currently at 615, which had run in parallel and just above the purple highlighted upper trend line, and then the lower trend line. The move high accelerated over the 38.2% Fibonacci line, the big old 2011-2019 move at 618, as well as the January 2015 high at 646. The now flatlining long moving average, currently at 646, the December 2023 high at 677, and through some significant resistances between 691 to 707, formed from the 50% Fibonacci line of the 2011-2019 move at 691, 50% absolute Fibonacci line at 697, and the December 2014 high at 707. I said as much 4 weeks ago, and I quote, "I do think prices can make it this high soon. It is a reasonable point of view, especially if you look at the last few weeks' action, as a potential bullish halfway hesitation, as it will lead prices right there as a target area. And the long moving average on its own would not necessarily be enough to hold down prices on its own, especially with the ammunition gathered in the rectangle below and earlier this year." End of quote. However, the market did not form a bullish half hesitation. Instead, it opted for a bull channel, which is currently 714 to 775, which is highlighted in dark blue on my daily chart. All is well and good with what lies ahead for the market. Well, is it all well and good for what lies ahead on the market? Well, we do have congestion at 763 to 764, 787 to 791, and 808. The first obstacle, and arguably the most significant of these, is the combined June 2014 high and 2022 low at 748. However, at the moment, I do not feel that this would be that much of an obstacle in any rise, given the amount of ammunition the market has accumulated since September last year. However, not far beyond that, and we do have some serious overhead resistances. This is not obvious on my daily chart, but back between January to August 2023, the market formed a huge inverted roof pattern that played out nicely thereafter. We start entering the apex of the inverted roof pattern from about 740. But it will take a little while to truly venture into it, so caution, though I do note the golden cross formed late 2 weeks ago as a supportive factor, if a lagging one. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpick and ADM Investor Service International Limited. And here comes the final important bit.